Good afternoon. Your market news now. As trading for the new year kicked off, shares in Asia were mixed, with some major markets in Hong Kong, in the region rather closed. Hong Kong's Hang Seng Index shed earlier gains and fell into negative territory. Trading in the shares and structured products of debt-ridden Chinese developer China Evergrande were halted in Hong Kong. Markets in Australia, mainland China and Japan are closed. Looking at what's happening in Europe, European stocks kicked off the new trading year with a bang, with most major regional indexes higher on the first trading day of the new year. Markets in the UK and Ireland are closed for the New Year holiday. And of course, everything will come back to normal from tomorrow and back to regular schedule with most of our market commentary when it comes to our analysts. However, moving on, according to Renaissance Capital, the two big dangers for the global economy are inflation, leading to a surge in U.S. bond yields, and real estate problems in China, leading to a global recession. I spoke to Charles Robertson about the emerging markets trajectory amid the pandemic, inflation growth, and China, and the key events that shaped 2021.
There's been a few. Turkey is probably one of the biggest, just because you never expect someone to take such a self-destructive stance on their own economy as the president has done. And even forecasts I was putting out at the beginning of November for the lira of something like 10 to the dollar or 11 to the dollar were just smashed through within days as they cut interest rates, and Turks themselves just gave up on their own currency. That's pretty remarkable. But luckily, the problems have been contained. I think bigger picture, US inflation, developed market inflation, I wasn't expecting it to go this high, nor was the market, to be fair, nor was the Fed. But the biggest issue of all, I still think, is China. So that collapse in kind of Evergrande bonds, the biggest property developer in China, the fall in the share price, the growing worries that this real estate boom, which has done so much to support global growth, actually for 10, 15 years, and commodities out of South Africa, that is in jeopardy. I'm not completely surprised. We worried about this even a year ago, that problems were brewing, but it's bigger than we expected.
So let's pick up on China a little bit. I mean, going into 2022, do you think it's going to be more of the same story? I mean, a lot of the market participants, some of their biggest surprises has been some of the regulatory intervention by the Chinese authorities and the effect that's had on the market. Do you see that being, I suppose, a similar tune going into 2022? Or do you think that things might be slightly different? How are you looking at China right now?
Utterly torn. So I'm worried. I'm worried because for more than 10 years, I've been concerned that when China blew up, it would be because of real estate. This is the Japan model. I think China is following Japan with about a 35-year lag. And Japan blew up in 1990. And that's telling us that sometime around now, you would expect property prices to be so elevated and the debt attached to that so high. And actually, we've been looking at some numbers which show that the debt level in China is at the same level as it was in Japan back then. So my concern is not so much the regulatory stuff. You're absolutely right, it shocked the markets in 2021. But this real estate problem could be much worse. It could give us a proper Chinese recession for 1 to 2 years. Oil prices dropping to $30, $40, demand for iron ore, coal, and all the other stuff that that South Africa produces getting badly hit. So we're crossing fingers and hoping the Chinese, who have got it right in every other crisis up to now, get it right again this time. But if they don't, it really will be a very dramatic problem for the world economy.
China aside for a bit, what's your assessment of overall emerging markets? I mean, you made a very interesting comment when it comes to the 5 stages of grief, and you talk about this particular period being a period of acceptance. Tell me a little bit about that.
Well, it's been a really tough decade for those who've been us in the emerging markets for some time. Back in the 2000s, it was fantastic. It was the period of the BRIC countries, the BRICS, when South Africa joined in. it was all growth and it was all good. And the last 10 years has been stronger dollar. Actually, the US looks pretty good. In fact, the US looks really good. In fact, all the best companies in the world are in the US, whether it's Apple or Google or Tesla. And people's appetite for emerging markets, even though GDP growth has been pretty decent, has just gone down. And as a result, we can see, I think, 8% global allocation to emerging market equities. If you did it on kind of GDP, it should be 40%. People just not putting money into emerging markets, at least not into shares.
Let's pick up on that theme of enthusiasm. I mean, from some of the people you're having a conversation with, where's the enthusiasm sitting when it comes to South Africa?
There's not an awful lot of enthusiasm for South Africa. I felt that this was going to be a very good year for SA. I thought the trade surplus was going to be amazing, which it was. And the rand would be quite strong or strengthening relative to 2020, and it did. Inflation would be quite low and interest rates would be quite low, and this was all going to be quite good. And I expected then that market interest rates and borrowing costs in South Africa would come down. The 10-year borrowing costs, which were 9% at the beginning of the year, could head towards maybe even 7%. And at that point, you look at South Africa's economy and say, well, if their borrowing costs are going down, doesn't matter how big the debt is, because the interest burden's falling, and that then makes the budget deficit smaller, and then maybe the country gets an upgrade at some point from the rating agencies. It becomes a better credit. People put more money in. I thought we were going to get into a virtuous circle. And then those riots happened in the summer. The government spends. The budget numbers were looking better, but then they decided to spend that extra money. The rand is now weakened off a little bit. Interest rates are heading up now, and suddenly the whole positive story is starting to erode.
When you were talking about the US and, we had Jerome Powell, give his press briefing. I mean, a lot of the other economists are saying that when it comes to what the Fed might do, they might have to move faster than they even anticipate. At the back of your mind, do you start wondering what a hawkish Fed looks like? And if that is the case, what does a hawkish Fed look like to you?
Well, our base case is that the US can't afford very high interest rates because its debt level is quite high. The risk case scenario here is that if inflation keeps higher than expected, say 3-4% next year, then the Fed does have to raise rates more, and that then puts emerging markets under a lot of pressure. So to me, the Fed funds much above 2% on a 2-year view would be concerning. My expectation is we get this quite flat kind of yield curve where it's 2% borrowing at one end and maybe 2.5% at the long end, 10 years borrowing costs from America. But if you start seeing that at 3 or 4%, at that point, people are saying, well, if I can get 3 or 4% in the US, I'm going to charge South Africa quite a lot more than that if I'm going to, and any other emerging market. And so much of the appetite that there has been for emerging markets has been in the debt space. So, but if America's offering me 3 or 4, I think emerging markets would then start to struggle on that front. And they'd have to start paying up themselves a lot more. And that leaves less money left over for investment. And it won't help the 5 stages of grief that emerging market investors are in.
Yeah. Before I let you go, there's so much happening, whether we're talking about the pandemic and the Omicron variant and various other issues happening in the background. What signals are you looking out for going into 2022 that will give you a sense as to where things are going?
On the virus? From
a macroeconomic point of view.
I think it's going to be an awkward few months at the beginning of the year because my main concern right now is China, which has a lot of double vaccinated people, relatively few triple vaccinated people, and no natural immunity, unlike South Africa or the UK.
That is Charles Robertson, who's the chief economist at Renaissance Capital. More business news with my colleague Nompumelelo Siziba after the break. It's a goodbye from me.